Hello and welcome to another episode of the Finance and Accounting Show with Terrell and Lola Turner. Excited to have you guys here, and we're going to go ahead and jump into today's topic. Today we're going to be talking about a problem that a lot of entrepreneurs are facing, and not only facing, but are going to have to be challenged with as they go through recovering from the pandemic and figuring out how to do business. And that topic is access to funding. And I don't have a better person that I think could talk to this better than my husband, Terrell Turner. So I'm excited to jump in. Let's go ahead and jump in, Terrell.
Absolutely. I think this one is definitely a topic that a lot of business owners are really faced with. And, what's very interesting is that, there was a survey done in North Carolina, and access to capital was one of the top things that small, medium, and large business owners talked about. I mean, because, and for some people that are watching the show, they may be thinking like, okay, all right, well, what does that really mean? What it means, as we tell people all the time, cash is king. And just like chess, when the cash is down, game over. So when it comes down to your business, if you don't have enough cash to fund your business, you really don't have a business. And that's going to be a big opportunity for a lot of businesses, is how do they find sources to get their hands on enough cash to run their business?
No, that's good. And one of the questions that I have is one of the in the survey that you mentioned that was done about access to capital. What are the types of capital that people can access? Can you talk about that a little bit?
Yeah, so I mean, you have some situations where you can either do it through investors, which means that you are giving up a portion of ownership in your business. So in exchange for them becoming a owner or a part owner in your business, they have to pay you X amount of dollars. And then you also have where you can go to a bank or a financial institution and you can take out a loan where there you're not giving up ownership, you're just making an agreement to say, hey, I will pay you back plus interest. And then I think in other situations where you may sell bonds, or I guess you pretty much you make a promise or an IOU to tell individual investors or institutions, hey, I need X amount of dollars today, but I promise that I will pay you this money back with interest when the bonds actually mature. And then, like I said, the other way, which is probably going to be uh, not a very accessible option for a lot of businesses, is going public, where you sell stock in your company, which, for your average business, they're probably not going to go that route for getting cash.
Yeah, so I want to dive into two of the things that you mentioned. Let's take the first one of the first one I want to talk about is as it relates to just getting financing from a bank. What are some of the things that you've seen that have kind of made or broken the ability for business owners to get that and have that funding approved? Because I know we have clients that you've helped through the process. So can you just talk a little bit about that?
Yeah, I think the first thing is businesses when they don't have like a good set of financial statements. So a lot of businesses, even when we look at 2020 with the round of PPP funding, a lot
Hmm.
of small businesses were not able to get PPP funding because they just didn't have financial statements. And that was one of the requirements when it came down to getting access to funding, where there were people, I have a list, I have a copy of my bank statement. It's like, no, that's not the same thing as financial statements. And
Yeah.
unfortunately, since no one was telling them the difference, they were disqualified. And I think another thing is just having a plan for the money.
Mm.
Because one of the things that I tell people is, when you show up at a bank, and this was confirmed, I had a conversation with, several commercial bankers. And one of the things that he was telling me, he said, I probably shouldn't be telling you this, but I'm gonna tell you anyway because you and I are having an off the books conversation. So I won't mention his name because his bank would probably fire him. But what I will say is, one of the things that he broke down, he said, you got to understand the economics of the bank. The
Mm.
bank's job is to sell you money in exchange for interest rates and fees. Now, if the bank is in the business of selling you money, when you show up and you give them your sob story or whatever, the bank really doesn't care. What the bank cares about is, if I give you this money, are you going to be able to pay me back? Now, one of
Mm.
the things that they look at is, okay, if I give you the money, what are you going to go do with the money? And are you going to do something that will allow you to increase your income to give me the security that you're going to be able to pay me back? Because if you're just going to take the money and you're just going to go, try to dig yourself out of a financial hole that you're in, for me, I'm not very confident that you're going to be able to pay me back at a later date. So the bank's probably not going to give you the money. So I would say the biggest things are, do you have financial statements? And then also, do you actually have a plan for the money?
So, as far as the financial statements go, is that actual, so past financial statements as well as financial projections of where you think getting this influx of cash will put your business?
I would say it's more of the latter,
Okay.
because that's where the bank wants, and I mean, part of the bank wants to understand is, what does your financial situation look like, and you're going to get that from the historical. I mean, because I mean, in reality, you can put whatever you want in your projections. Those aren't really set in stone. But a
Yeah.
lot of times, banks and financial institutions are going to go back. They want to see, okay, what do your financial statements look like? And then if they want to get even more certainty, they either require you to get an audit. If you're a really big business, they'll require you to have audited financial statements,
Hmm.
or they'll ask for a copy of your tax return, because the confidence is that if you reported this income or losses on your tax return, that it's probably legit. So they're probably going to ask for the last 2 years worth of tax returns, to really kind of validate the historical of where you've been. Now, if they like where you have been and they see that, hey, there's potential for you to pay us back, then they may start asking, okay, all right, what are you going to do after you get the money? That's where they may start to look at your projections.
Okay, so a lot of it is heavily focused on what your business has done in the past from a revenue, just the financial statement standpoint. Is there a specific area of the financial statements that they focus more on? Is it income statement, balance sheet, and then specifically for those statements, are there specific key things like revenue or other things that they're really paying attention to?
I mean, it's overall, if you think about it this way, because it is a little bit of a mixture, and it kind of depends on what industry you're in. Because
Hmm.
overall, the bank is trying to lower their risk. The
Hmm.
bank is trying to say, okay, all right, their job is to give other people money so that they can collect interest and fees. And so their thought is, if I give a person a loan that can't pay me back, I'm not going to be able to collect interest and I'm not going to be able to collect fees. So their thought is, all right, based on the nature of your business, like if you're a service based business, they're probably going to look at your income statement because you probably won't have a ton of stuff on your balance sheet. They're going to look
Hmm.
at your income statement and say, okay, all right, do you have enough revenue and where are your expenses? Because I want to make sure you have enough profit coming into your business to be able to pay me back. Because the bank knows, if I give you this loan, you're going to have to pay me, let's say, $500 or $1,000 a month. They're looking at your numbers to see, can you afford to pay me that amount of money? And if you can't afford to pay me, then I'm not going to give you $1,000 because it looks too risky for me. Now, if you're a business that actually buys like equipment and or let's say you're a business that has physical inventory, what the bank may then consider is, okay, what's the value of the equipment? What's the value of the inventory? So if you don't pay me, maybe you can sell what you own to be able to pay off the gap if there's an issue that happens in your business. Or in some cases, the bank is like, hey, they'll take ownership of your physical property in exchange for the debt that you owe.
Got it. Okay. I want to move on to the other type of funding that you mentioned, which I think is also more common, the investor part. What are some of the things that you would kind of tell people, hey, if they're looking to maybe go the investor route, these are some of the things that they need to think through and consider?
First thing I always tell people, if you're thinking about taking on an investor, I would say stop for a second. Let's really ask ourselves, do you really want to go that route? Because one of the things that people don't realize, is whenever you take on an investor, what that means is you are now giving someone else a seat at the decision making table. Because it's so interesting when I find people, they're like, I got this great idea for this business. Now I need to go get an investor so I can go move forward with my idea. And it's just like, you do realize no one's going to give you that kind of money and not have a say in it. Like,
Right.
you're not going to be able to just run with your idea. If someone else is investing in your business, they want a seat at the table in making decisions. And what often happens with a lot of entrepreneurs and a lot of business owners is they bring on an investor, and the investor may or may not like the direction that they're going. And they're like, hey, I want to change this. I want to change this. And if you're not prepared for that, it could
Hmm.
completely derail kind of your plan or your objectives that you were after. So I tell people the first thing is, before you take on an investor or you take an investor's money, understand that it is going to come with some requirements. The next thing I always tell them is, know that an investor is not investing in your business because they just like you or they just
Yeah.
like your idea. They are investing in your business to actually make a profit themselves. So, whatever amount of money that they're giving you, they're judging to see, can this business grow bigger than it is now so that I can make a profit? Now, sometimes what that means is, like, if you're going bigger scale, let's say if you're going venture capital or you're going, private equity, they're looking to make 10 times the amount of money that they just gave you, which means you better be ready to grow very fast. And that comes with a whole lot of, I guess you would say, fast paced moving, a whole lot of grinding, a whole lot of pushing. Because for a venture capital fund or a private equity fund, they need to return a pretty big return on investment so that they can pay their investors back. So you got to ask yourself, are you ready to grow that fast, or are you ready to put in the work to grow that fast? And then I would say, all in all, you have to ask yourself, if you get the money from the investor, what are you going to do with the money? And will that actually help you grow your business to the next level? Because you want to grow your business, the investors definitely want you to grow your business, because if you don't grow, they don't make any money. So they definitely want you to grow. So I always tell people, consider those three things.
That's good. At what point would you say someone kind of goes from seeking traditional funding or bank loans to being able to get their business to the point of actually seeking out investors? Is it just based on the popularity of the product or the kind of business that they're selling? What would you say would be, the differences between someone if just goes for traditional bank funding versus someone actually trying to get investors?
I always say, I think if you are comfortable with bringing other people to the decision making table, and I would say evaluate your investors and ask yourself, does that investor have knowledge, insight, or access to relationships that will help the business grow? Because if all that investor has is money, I'm not necessarily sure that that's the right move, because you can go get money from other places if your idea is good enough.
Yeah.
And so I always ask, like, hey, are you at a point where, you have reached the limit of how far you can take this business? So now you need to bring on partners with capital to be able to take the business to the next level. Because I tell people that, you know, either try to self-fund the business as much as you can, and not necessarily from, hey, using your own personal bank account, but the way you run your operations, like, get your business to positive cash flow so your business can fund itself. Now, when you want to scale and take it to the next level, consider, low interest rate financing, like, going with a financial institution to see if you can get the money, because that way you still have control over the decisions. Now, if none of those options are available, then consider, I would say, bringing on an investor, which an investor, you want to make sure that they're not just bringing you money and they're going to throw their decision-making weight around, but that they're bringing money. They either have relationships, they have knowledge, they have wisdom, they have insight to add value to help you grow your business in a smarter, more effective, and a more successful way.
That's really good. That's really good. And I think that's why shows like Shark Tank are really popular, because not only are Mark Cuban and the Sharks bringing their money, but they're also bringing in their relationships and their expertise, because a lot of times that's really what makes a difference. So thank you, Terrell, for sharing your insights with us. If you're looking for more information and detail on really how to get that bank loan funding, we actually have a course at Business Talk Library University that I would highly recommend and walk through, that's actually taught by Terrell himself. And thank you guys so much for watching, for listening to the show, for supporting the Finance and Accounting Show. You can do some more supporting by leaving us a review on across the different platforms where you listen to the podcast. And thanks again for checking out this episode. Until next time.